If you're on Medicare and you sell investments with a big gain, you might accidentally trigger higher Medicare premiums for an entire year. This is something that catches a lot of retirees off guard. So maybe you rebalance your accounts, you sell a house, or you cash out a big stock position. Then 2 years later, your Part B and Part D premiums go up. And this isn't a mistake, and it's not something that happens all the time. It's due to something called IRMAA. Today I'm going to go over how capital gains can push you into IRMAA and what you can do to plan around it. I am Sam, certified financial planner and the founder of Wealth Guides. I've worked with a wide range of people over my career, but my practice has become more people that are approaching retirement or are already retired. But one of the most common hidden taxes that I see amongst my clients and amongst people that I talk with is how investment decisions show up years later in the form of higher Medicare premiums. So let's break down how that happens and how this actually works. So first off, what is IRMAA? When you're on Medicare, there is a standard premium for Part B and Part D. But if your income is above certain thresholds, you pay an extra amount each month. Now that extra amount is called the income-related monthly adjusted amount, or IRMAA. IRMAA is essentially a surcharge that is based on a number from your tax return from 2 years ago called your modified adjusted gross income. So now what makes up your modified adjusted gross income? Well, it's your adjusted gross income plus any tax-exempt interest, so think mortgage interest, and things like municipal bond interest. But if something's increasing your adjusted gross income, there's a good chance that it's also increasing your modified adjusted gross income, which means that it's increasing the income that Medicare takes into account for calculating your premiums. It's the income that affects whether you fall into this IRMAA bracket. So where do capital gains factor into this? So when you sell an investment in a taxable account, such as a stock, a mutual fund, or an ETF, and you sell it for more than you paid, that profit is a capital gain. That gain will then show up on your tax return, and it becomes part of your gross income. Then it becomes part of your AGI, and then it becomes part of your modified adjusted gross income. So a lot of people will have capital gains that will show up in a given year without even realizing it. Or maybe you did realize it, and you're doing something big, like selling your house, but it doesn't affect you in the current year. Well, for Medicare purposes, it may affect you. Now, it's important to note here that when we're talking about investment decisions and gains and losses and profits, we're talking about exclusively in a taxable brokerage account. Money that's in an IRA or a 401k is in a tax-deferred account. Or in the case of Roth, it may be a tax-free account. But any trades that are going on inside of retirement accounts like those are not going to be ones that have to worry about capital gains. So therefore, trades within those accounts, not for withdrawal purposes, but just inside the accounts, are not affecting IRMAA. So the danger with IRMAA is usually associated just with taxable accounts, taxable withdrawals, not with moving things around inside retirement accounts. So now that we've explained that, let's walk through an actual example. So imagine that you're retired and your normal annual income is around $80,000. Now maybe that's a mix of Social Security and some withdrawals from your IRA or what used to be your 401k. At that level, you're comfortably under the IRMAA thresholds and you're paying the standard Medicare premiums. Now let's say that you have a large position in a taxable brokerage account. Maybe it's a stock that's done really well for you or a mutual fund that you've held for years. If you decide to sell a big chunk of that position and realize $60,000 of long-term capital gains in that 1 year, on your tax return for that year, your modified adjusted gross income doesn't show $80,000 anymore. It'll reflect $140,000. That is your normal $80,000 plus the $60,000 gain. So even if it's just a one-time event, that higher income is what Medicare will see 2 years later. If that pushes you over one of the IRMAA thresholds, your Part B and Part D premiums can jump. And when they jump, you can pay the higher premiums for that entire year. Okay, so we know what IRMAA is. We know what effect it can have when it kicks in. So how do you plan around it? Well, like with any sort of tax planning, it's know where you are relative to the thresholds. Every year, Medicare publishes income brackets for IRMAA. Here is what the 2025 IRMAA brackets are. The important thing to know here is that these thresholds are what's considered cliff thresholds. If you go even $1 over, you can jump into the next tier. So if you're already close to the threshold, realizing a large capital gain can be exactly what tips you over. Now, I think it's important to mention here that sometimes carrying a large unrealized capital gain position and not wanting to sell it for fear of an increase in Medicare premiums can actually be a worse consequence than paying those higher monthly premiums. You may be better off diversifying that before the stock price declines and you lose all of the value of that concentrated position. Now, another way to plan for this is to use lower income years more strategically. These might be the years right after you retire, or the years before you start Social Security, the years after one spouse retires, or it could be the years before required minimum distributions kick in. And if you're not at Medicare age yet, be considerate of what your income is going to look like in the years when you're 63 and 64. Because those years, that income will affect what your future Medicare premiums will be. So you have to start thinking about this before you actually get on Medicare. But those years where you have lower income, those valley years where you look and say, hey, yeah, I am retired, but my Social Security hasn't kicked in. We have a few years before we're on Medicare. Those might be years to harvest capital gains because your baseline income is lower. So the third thing you may want to consider is coordinating your capital gains with other moves that are affecting your income, like Roth conversions and large IRA withdrawals. If you have a year where you're doing a significant Roth conversion, adding a big taxable gain on top of that can bump you into a much higher tax bracket and a higher IRMAA tier. It doesn't mean that you shouldn't do it, but it's often better to space these moves out over multiple years instead of piling a lot of it all into one tax year. Now, there are ways to appeal IRMAA in certain cases. If your income drops because of a life-changing event, you can actually file a form with the Social Security Administration and ask them to base your premiums on your more recent lower income. Now, it doesn't apply in every scenario, and I wouldn't get your hopes up that that's going to be something that's accepted, but it's worth knowing that that option does exist. Okay, so to recap, your Medicare does look at your modified adjusted gross income from 2 years prior to when you're paying. Realized capital gains in a taxable brokerage account will affect your modified adjusted gross income, which will affect your Medicare premiums. So with a little planning around where you are relative to those thresholds where IRMAA kicks in, can help in avoiding getting surprised in paying higher premiums. If you're someone that is approaching retirement or approaching these decisions and you want a second opinion or you want some ideas that are personalized to your plan, this is something that we help people with, and I'd be happy to take a look. Feel free to like and subscribe to see more of my videos on retirement, taxes, investments, and other things that affect your finances. Thanks for watching, and I hope to see you in a future video.